Hello, everybody, and welcome to the Dorsey Wright podcast for Wednesday, May the 13th. I'm Jay Gragnani, and here joining us this week is Ian Saunders. And as Ian just pointed out, right before we hit the record button to go live, May 13th is now roughly halfway through the second quarter. And man, that is very hard to believe.
Absolutely. It feels like just yesterday there we were coming into April amid the volatility, and see some further volatility as we're about halfway through here now.
Yeah, you're absolutely right. I mean, just this week alone, as we're filming this with the Dow down about 500 points, you've seen almost 1,000 points wiped off the Dow index just so far this week. So in about 3 trading days, and the volatility certainly is still here. And the action of today, the Wednesday the 13th, again, as we're talking about it now, the Dow's down about 500 points, but there are a lot of stocks down as well, and down, notably. And so one of the widgets that's interesting that you can make available on your dashboard, if you're logged into your website on your dashboard, is the major intraday changes widget. And this gives you a sense of what the current day's market is doing and how it's impacting individual bullish percent charts primarily, but you can also see the numbers of stocks giving sell signals, number of stocks giving buy signals, et cetera, et cetera. And one of the things that we wanted to highlight today specifically is the New York Stock Exchange bullish percent. And when we look at that indicator, you see on the right-hand side there a minus 13.31. That's telling us that's the current day's action, the intraday action. The bullish percent is down over 13%, and that will put that chart down at 48% overnight, assuming everything stays roughly in line today. And that's significant for a couple reasons. One, if we look at a chart of the bullish percent, and we saw action last week that the bullish percent moved all the way up to 70% here recently in that rally. And that 70% line historically has been an area and a line of demarcation that we talk about as being more overbought, more red zone, more higher risk level. A lot of times when the comments that historically have been made around the bullish percent is when that bullish percent gets up to 70%, the vast majority of people that want to be participating, want to be invested in stock are in there, and there's not a whole lot of net new potential demand sitting on the sidelines. Well, that was the first time we'd hit 70% since January of 2018. Prior to that was July, August period of 2013. Nonetheless, we saw that indicator reverse down last week into a column of those after hitting that 70% level, which at that point took the bullish percent from having a bull confirmed risk level to bear alert. And that bear alert risk level is something that is a sign of caution. A move from here to 54% would exceed a previous low and would shift that status, the risk level status, from bear alert to bear confirmed. And that's that's taking place today. As you see, that indicator will fall. It doesn't show on the chart, but when we looked at the intraday report there, show a fall down to 48%. So right now you're looking at a picture and an environment where the bullish percent had reversed down in O's last week, putting the defensive team on the field, so to speak. We've seen that further deteriorate now, moving that risk level to bear confirmed at 48%. So that is certainly sign of caution in the market. That certainly sign something to take note of, especially given the backdrop of the rest of the equity market indicators.
Absolutely, and when we've seen this movement, as you mentioned there, we had about 1,000-point drop over the last few days in the Dow. We've seen a drop as well, obviously, in the S&P 500 index on the back of some of these movement. Obviously, the bullish percent for the NYSE is looking at many more names than just the 500 large cap names that the S&P is looking at. But when we look at the 20-point chart of the S&P, we saw this index actually creep back on up to form a double top pattern with trading there over the past week at 2940 before reversing back down into a column of O's with movement yesterday afternoon. A very sharp sell-off that we saw at the end of the trading day yesterday led to a 3-box reversal down from that resistance point there at 2940 down to the 2880 level. And then with movement here today, we have the broader S&P 500 is moving right on down towards its first support level that we come to from earlier this month at 2800. Printing another 4 O's as of the time of this recording here on Wednesday to sit right at that support at 2800. So further decline from here down to 2780 would lead to the S&P 20-point chart to return to a sell signal here. Been on a buy signal since the end of April. But then we would be looking towards further support from that level at the 2740 threshold, which is held on 2 previous occasions in April. And interesting to note as well, Jay, we were talking about that the last time that support level held, it did hold on a sell signal, which is definitely an interesting point to look towards if we do move lower to give a sell signal here and creep back down towards that 2740 threshold.
That's right. Yeah, you look at the chart of the S&P, and I think intraday the S&P hit 2799, at least as of Wednesday afternoon. So certainly down there testing support. But you're right. There is some notable support down there at 2740 for the S&P 500. You mentioned something too that I think is probably worth digging into a little bit in terms of just the different weighting of, say, the S&P 500, which is a cap weighted index, versus like the bullish percent, which is an equal weighted indicator where every single stock receives the same vote. And if you think about that, we don't often think about how different indexes are weighted. And you think about the S&P 500. The S&P 500 is a capitalization weighted index. The larger stocks in the index by their market cap get the most vote or most weighting within the portfolio. And the S&P 500 right now, through yesterday, so through Tuesday's close, was down about 11% year to date. Given all of the volatility that has happened, Microsoft and Apple are the 2 biggest weighted stocks in the S&P 500 because they have the largest market cap right now. If you take those same 500 stocks, so S&P 500 cap weighted down 11% year to date. If you take those same 500 stocks and you simply equally weight them this year, and that is the S&P 500 equal weighted index, that index through yesterday would be down 20 or was down 20%. And so then you go and look at other indexes like the Dow Jones Industrial Average. The Dow Jones Industrial Average is a price weighted index. So whichever of the 30 stocks in that index have just the biggest share price, not necessarily the biggest market cap, but the biggest share price, then that is the most important one. And Apple shows up in there as well, but United Health Group is a very large weighting is in the Dow Jones Industrial Average as well, because the price of that stock is high. I mentioned this just to say that when we look at the market and we look at the S&P 500, there have been a handful of stocks really holding up the S&P 500 index, while a lot of stocks underneath the surface have struggled to do so. Many small cap indexes still down about 20% on the year. And so when you see things like the bullish percent reversing down from high levels, and especially today giving a sell signal, certainly is a sign of caution out there for the market. And then you see here the chart of the S&P 500. Similarly has given a sell signal on its chart. The S&P 500 equal weighted index that you're looking at here on the screen, interestingly enough, was not able to get back into a positive trend. It stayed in a negative trend, has returned to a sell signal, and is now close to testing that support there at 3,600.
Absolutely. And we've seen some of this downward movement reflected from an individual sector perspective as well. One of the main sectors that we've been focusing on here over the past few weeks has been the energy space. I mean, it's risen. Mm-hmm. We talked about over the past week, it's risen from towards the bottom end of the dollar rankings to be ranked second through trading yesterday there, sitting just behind technology. We've seen a pretty significant rally from a lot of energy names on the back of the rally from the oil space. And taking a look here at the broad fund representative with the Energy Select Sector Spider Fund, we saw that fund fall significantly this year from a level at 62, reversing down into a column of those in January, much prior to the broader market drawdown, but then continuing significantly lower amid all of the market volatility to reach a near-term low of $23 on that chart. Very significant decline. But since that time, the charts popped pretty significantly, moving up to get 5 consecutive buy signals to top out at 39 at the end of April. Seen some sideways movement over the past couple weeks here, and then ultimately today's movement, looking at a down day, at least as of now, of about 4% for the broader Spider Fund XLE, putting us reversing down into a column of those and actually giving its first sell signal since that initial pop back up there at $36 on that chart. So still have some near-term support offered for the energy space, but definitely some interesting moves. And as we see this name has been one of the leaders over the past couple of weeks, seeing it move quite a bit further south here with trading on Wednesday.
Yeah, you're right. I mean, energy sector is one that has certainly been in the headlines with what has gone on with crude oil over the course of the past month. And energy off the bottom has been the best performing sector off the bottom. And that has certainly shown there in the chart. It's given a number of buy signals, but the move to number 2, the second ranked sector, and Dolly was significant over the course of the past few weeks, as we haven't seen that energy ranked that high in Dolly since the July 07 to the July 08 time period. And there's been a lot of that this year of we haven't seen XYZ since the 08 time period. There's been a lot of those type of comments made, and energy is just another one of those. And during that time, for about a year, energy was either the number 1 or 2 ranked sector. And back then, I mean, July of 2007, crude oil prices were about $70 a barrel. And here we're looking at crude oil prices in the $20 a barrel. And by July of 2008, crude oil prices had nearly doubled, at reaching $147 at its peak in July of 2008. So, certainly a very, very different environment, a very different time period. But, energy also back then in 2009 accounted for about over 12% of the S&P 500, versus today it's about 3% of the S&P 500. And so it is, one of the lowest weightings in terms of sector goes in the S&P 500, versus back in 2009, it was the 3rd highest ranked sector, or 3rd largest sector, I should say, behind technology and healthcare, believe it or not. So technology still the top ranked sector. That sector has gained, going from about 15% in 09 to up to about 26% today. Again, just kind of going back to the idea of understanding what's inside of the indexes and which sectors have meaningful action within the index. Right now, technology still the number 1 ranked sector in Dolly, and is also the largest sector when you look at the S&P 500 today.
Certainly, and since you mentioned technology there, and kind of comparing and contrasting some of the broader sector funds, and looking at the broader technology representative there from Spider X, ticker XLK, Technology Select Sector Spider Fund, we see the negative movement today reflected here in this name as well, with the name down at almost another 2%. Following a decline up to about 2% there with trading on Tuesday, leading to a reversal down into a column of those on this chart from a chart level of 96, putting us down at a chart level currently at 91. But interestingly enough, we see that this chart was on a little bit more of a stem, so this movement lower today is not leading to a sell signal, at least right at the time of this recording. The initial support level would come down at 89, with that first sell signal to be given there at 88. So we've seen many of the technology names as well be creeping on back towards overbought territory. This particular ticker, XLK, was not in overbought territory prior to today. It was at 43% from a weekly overbought oversold standpoint. But many of those sectors, or those sector funds that have been leading this market rally, whether it be in technology or in healthcare, that has also led a significant amount of upside movement over the past several weeks. Many of those names, we've seen them creeping back towards overbought territory, and many of them surpassing overbought territory, moving above 70% overbought, over trading over the past week or two here. And we've seen that reflected through the asset class group scores page. One way you can take a look at that is setting your view filter to the sectors view on that page, and come in and view some of the higher scoring sectors in those areas that might not be scoring that as well. We've seen biotech, healthcare, internet, and technology be 4 out of the 5 top scoring groups out of the entire asset class group scores page, with 135 different groups. Interesting to see those 4 funds being right up there towards the top out of the broader space. But they're also getting more overbought than many of the other areas, at least on the domestic equity sector breakdown, with movement prior to yesterday's decline, placing some of the sectors in overbought territory. After yesterday's decline, you see each of those are going to be just below that 70% threshold that we typically use as kind of a line of demarcation. But many of the funds may still be above that threshold, at least prior to today's movement. So definitely some interesting points to take note of, that with this broad market rally that we've seen from those lows, some of those leaders that have been taking us up there have been up on significant SIMs over the past week or two here.
That's right. Yeah, and we haven't really seen, I mean, it's in the past few days, no evidence of leadership changes, but certainly, meaning, technology, the biotechs, the internets, the healthcare sectors, those remain the leaders from a relative strength perspective. While the other end of the spectrum, and for a while now, you look at areas like banks and real estate and financials, those sectors have really come under intense pressure through this market turmoil that we've seen. That it's hard to think, geez, May 13th now. We're now almost 3 months removed from talking about the all-time high back on February 19th in the S&P 500. And, some of those sectors certainly caught the brunt of the volatility, the real estate and your financials. And the bigger theme really there has been value, has been out of favor for quite some time this year. And as you saw, one of your value funds ranking down there, or value groups, I should say, ranking down there at the bottom. You can also look at U.S. styles, and you see small cap value right down there at the bottom, with mid cap value as well as large cap value, all being groups that are in the red. And that red just means that their scores are below the 2.5 line there. So all the value scores being down there in the red. And it's interesting when you look at going back to the S&P 500 for a second. If you just look at the growth segment of the S&P 500, RPG is an ETF. The S&P 500 pure growth ETF through yesterday is down about 7%. On a year-to-date basis. So again, through yesterday, through the 12th, is down about 7%. The value S&P 500 value ETF symbol is RPV. That ETF, again, just S&P 500 stocks, but the value side is down almost 38% prior to today, prior to Wednesday's market action. And so, very, very big dispersion there when you look at the difference between growth and value stocks this year. And that's really shown up in the technology, your growth-oriented sectors being those that remain dominant, while the value sectors are the ones that have been hit the hardest this year.
Certainly.
Yeah, and then that's just looking at kind of the U.S. markets, though. But international markets have seen some interesting action here over the course of the past few weeks as well.
We have, at least they have, rather. And looking at the broader international space, the two typical representatives that we're going to look at for the developed and the emerging side, look at the iShares representatives there, with EEM being the representative for emerging markets. We saw emerging markets fall out of bed a little bit more than their developed counterparts, moving lower from a near-term or 52-week high, rather 46 on the chart in January, to ultimately give 5 consecutive sell signals, moving to a near-term low at 30.50 on that default chart. Since that time, however, we've seen this particular fund rally back up with the broader global equity markets, not as much as the US side of things, but still rising off of that low to give 2 consecutive buy signals, most recently at the end of April at 35.50. And then with movement yesterday morning, prior to yesterday afternoon's decline, this fund actually continued higher to reverse back up into a column of X's there at 37 to sit 1 box shy of testing its now longer term bearish resistance line, which would come in at 37.50. So if we see that fund move to 38, that movement would give a 3rd consecutive buy signal and also flip the trend back to positive for the broader emerging markets representative. With trading here today, we're looking at some negative movement, but not enough movement to cause a reversal down into a column of O's. Looking at a level at 36.30-ish right now, and we would need to get down to 35.50 to reverse back down into O's, which would also be at a near-term support point from earlier this month. See a pretty similar picture on the developed side of things too. Not quite as close as EEM, looking at the ticker EFA, iShares MSCI EFA ETF there. Fell lower this year, giving 3 consecutive sell signals. Again, we see 2 consecutive buy signals, rising up from a near-term bottom of 46 to a recent chart level of 57. Again, moving a little bit lower with trading here today. But not enough to reverse down into O's. And EFA sits a little bit further south with 2 boxes to go until it gets to its test of its positive trend line. If we do see that upwards movement continue, which would come there at 59, it would be move back to a positive trend with movement to 60. So 2 points to keep an eye out for in the international space. Haven't seen all that much improvement from a relative strength perspective for the broader international space, but with some of these broader representatives moving back towards positive trends, could potentially be a place to watch out for in the weeks to come.
Yeah, interesting charts on the international markets there. You know, similarly, we saw the S&P 500 move back into a positive trend in April. Haven't seen a lot of international indexes follow suit, similar in scope to what we saw with the S&P 500 eco-weighted index. So it will certainly be interesting to continue to watch as those charts develop, and you know, really as the world continues to develop and figure out what the new normal is going to look like as we move forward, and discussions continue on how the economy is going to open back up, and people get back to working again and working more normally. But in the meantime, we continue to operate here at Dorsey Wright in predominantly work from home environment. Nonetheless, we're here to support you. If you have any questions, comments, concerns, please don't hesitate to give us a call, email, and we're here to help. So with that said, hope everybody is staying healthy and safe out there. Look forward to seeing all of you very, very soon. Hopefully it won't be too long. In the meantime, appreciate you joining us this week, and look forward to talking to you again soon.